Okay, here is the first financial statement that deals with Jane's first transaction. Note that on the left side are the assets. On the right side are the liabilities and equity. This is where the term balance sheet comes into play, because the total assets will always equal the total liabilities and equity. In this case, Jane has taken $100 from her piggy bank, started a business checking account, and put the $100 in it. There's always two sides to every accounting transactions to keep things in balance. And in this case, we see $100 in her checking account on the left, and $100 going into an account we call owner's equity on the right. Now we see the second balance sheet where the first business transaction has taken place. Remember the $100 that was in her business checking account. She's taken that $100 and she's bought inventory. So now we see how that is reflected, and still the total assets equal the total liabilities and equity. Note that she's buying these cans of lemonade for $5 a piece, and 20 times 5 is the $100. In this slide, we see the first sale that Jane has. She sells 20 cans of lemonade for $120. That means that she sold them for $6 a piece, which means that she has had a dollar profit on each money. So she has, quote, made money in that she's got a profit of $20. However, one of her sales was to someone who asked if she could pay this later. And it's extremely important to understand the concept of accounts receivable. You'll see how this becomes an issue going forward. In this case, the $120 of sales, $60 in cash and $60 in accounts receivable. Well, that means her $100 of total assets has grown to $120, which is the profit that she's made. So on the right hand of the balance sheet, we see the original owner's equity plus the profit of $20. Profit or loss, as the case may be, are a component of equity. So now you can see that the total assets and the total liabilities still are equal at $120. Finally, we see the second of the two most common financial statements, and that is a profit and loss statement. And this shows the components of that $20 that went into profit, the sales of the cans at $120. The cost of sales is the 10 cans, $5 a piece times 20 equals $100. So that this concept is something that need to keep in mind. This cost of sales is the actual cost of the inventory, and the $120 is the actual sales. So the profit is the $20, which was shown on the balance sheet in the previous slide.